Okay, so we've got a pretty hefty stack of articles here from Business and Accountancy Daily. And, our listeners are really keen to understand what's on the horizon when it comes to UK tax and inheritance, especially with this new budget looming. And
Yeah.
it seems like the government might be, it sounds like they're gearing up for some pretty big changes.
Yeah, there's a lot of speculation right now, particularly around inheritance tax and capital gains. And I think what's interesting is not just the potential for change, but the context. The UK is potentially facing a budget deficit, and inheritance tax, which is always a bit of a hot button issue, seems to be right in the spotlight.
Yeah, and it makes you wonder right off the bat, like if they start tinkering with the inheritance tax, who's that really going to hit? Is this something that's going to impact everyday people, or are we talking about a very specific demographic here?
That's the million-pound question, isn't it?
Hmm.
I mean, inheritance tax in the UK is essentially, it's all about what happens to your estate, your money, property, valuables, the whole shebang after you're gone.
Yeah.
And currently, there's a threshold, right? So if your estate is valued above a certain amount when you pass away, your beneficiaries, well, they get hit with a tax on anything over that line.
Well,
And what these articles seem to suggest is that the government might be considering lowering that threshold. So potentially, catching more people in the net, so to speak.
so a wider net, bringing in more revenue, but also impacting, a much broader range of families and individuals.
Exactly.
And we're not just talking about straight inheritance tax changes either. There's this whole other layer with the capital gains uplift reform being thrown around.
Right.
And honestly, even for someone who tries to follow this stuff, it's a bit of a head scratcher.
It's definitely a nuanced area.
Yeah.
And yeah, one with potentially really significant implications.
Mm.
So imagine this, right? You inherit your grandparents' house, a house they bought decades ago, for a fraction of what it's worth today.
Right. Now, under the current uplift rule, you would only pay capital gains tax on any increase in value from the time you inherit it, not the original price your grandparents paid.
So you're basically off the hook for all those years of appreciation that happened before you came into the picture.
Precisely. However, the government is now floating the idea of reforming or potentially even scrapping this uplift. And if that happens, inheriting assets could get a lot more expensive because beneficiaries might have to pay tax on the full increase in value, dating all the way back to the original purchase.
Wow. So we're not just talking about a bigger tax bill on your inheritance. We're talking about potentially a MUCH bigger bill.
Potentially, yeah.
No wonder people are concerned. And speaking of concern, let's talk about the potential impact on farmers and business owners. One article really highlights the anxiety surrounding potential changes to agricultural property relief and business property relief.
Yeah.
And there's a real sense that these changes could have a ripple effect far beyond just individual tax bills. Absolutely. And this is where things get really interesting because we're not just talking about numbers on a spreadsheet. We're talking about livelihoods, legacies, the very fabric of rural communities. I mean, think about it. For many farmers, their land is their most valuable asset, even if their actual income doesn't necessarily reflect that. Agricultural property relief, or APR as it's known, provides a vital lifeline by essentially reducing the value of that land for inheritance tax purposes.
Yeah.
Take that away, and you're potentially forcing families to sell off land that's been in their family for generations just to cover the tax bill.
Yeah, it's like this domino effect. You start with a tax change, and suddenly you're talking about the breakup of family farms, the potential loss of local food sources, and a reshaping of the entire rural landscape.
It's a big deal.
That's huge.
It really is. And it's not just farmers who are feeling the heat. The articles also highlight concerns about potential curbs on business property relief, or BPR. And this relief works similarly to APR, but it applies to businesses being passed down, often through families.
So it's not just about the family farm, then it's about the family business too. Like these potential changes seem to have a real impact on how businesses are passed down through generations.
Yeah, absolutely. And for many families, their business isn't just a source of income, it's their legacy. It's their life's work. In fact, one of the articles I have here actually uses the term death taxes to refer to taxes levied on estates after death. Kind of grim when you think about it, but it makes you think about the kind of language being used around this.
Yeah, it does feel like heavy stuff. And, we've talked about this potential for a complete overhaul of the capital gains uplift rule. Is that essentially what they mean by death taxes? What would that actually look like in reality?
Essentially, yeah. The government might be looking at this uplift rule, where you only pay capital gains tax from the point of inheritance and seeing it as a bit of a loophole. And closing that loophole could mean a significant cash injection, especially in the current economic climate.
Right, because if you inherit something that's significantly increased in value over, decades, the government's not getting a cut of those gains, at least not under the current system.
Exactly. But it's a tricky one, isn't it? Because on the one hand, it does seem like a huge burden to suddenly be taxed on the full lifetime of a business's growth. But on the other, those taxes go towards funding public services, which benefit everyone. It's about finding that balance.
It always is, isn't it? Finding
Okay.
that balance. And speaking of a delicate balancing act, the article also mentions these possible curbs on agricultural property relief and business property relief. For someone who maybe just turned in, why are these reliefs so crucial, and what's the worst case scenario if they are tampered with?
Okay, so imagine you're a farmer and you've inherited your family farm, right? Now, the land itself might be worth a fortune, but your actual income is relatively modest. Without that agricultural property relief, you could be hit with an inheritance tax bill that's just impossible to pay without selling off a huge chunk of the land, maybe even all of it.
And for a lot of these farming families, that's not even an option. It's about holding on to something that's been in the family for generations, that deep-rooted connection to the land.
Exactly. And the same principle applies to business property relief. For a family business, that BPR can be the difference between passing on a legacy and being forced to sell out potentially to a larger corporation just to cover the tax burden.
It's almost like a double whammy then. You've got this potential removal of the capital gains uplift, which could result in this massive tax bill on inherited assets. And then on top of that, you're facing curbs on these vital reliefs that have historically protected family farms and
Right.
businesses. That's a lot to contend with, especially when you factor in things like, the rising cost of living, economic uncertainty.
Absolutely, yeah. You've hit the nail on the head. It's like a perfect storm of potential challenges. And this is where that proactive planning becomes absolutely crucial. The articles really highlight time and time again the importance of getting expert advice, talking to a financial advisor, exploring all options, really understanding the nuances of these very complex tax laws.
It sounds like knowledge really is power in this situation. The more you understand, the better equipped you are to kind of navigate these potential changes. And speaking of knowledge, there's this staggering statistic mentioned in one of the articles about unnecessary inheritance tax payments. Apparently an estimated 327 million might have been paid out unnecessarily.
Wow.
That's a huge amount of money. What leads to these kinds of overpayments?
It is a staggering figure, and often it just boils down to a lack of awareness and understanding. Inheritance tax is complicated. There's so many intricate rules, exemptions, and reliefs. It's easy to make mistakes. It's easy to overlook potential savings if you're not well-versed in the ins and outs of all of these laws.
So it's not necessarily about people deliberately trying to avoid paying. It's more about just not knowing what they don't know.
Exactly. People often just put off thinking about inheritance tax, either because it's uncomfortable thinking about our own mortality, or because they simply don't realize the importance of planning early.
Yeah, it's like that old saying, failing to plan is planning to fail. But in this case, failing to plan for inheritance tax could mean your loved ones end up footing a bill that's far larger than it needs to be.
Exactly. And the other crucial point is that tax laws aren't static. They're constantly evolving. What might have been true a few years ago might be completely different now. It's a moving target, which is why seeking that expert advice is so important.
So be proactive, seek expert advice, stay informed. That seems to be the overarching message here. But let's shift gears for a moment and revisit Companies House. We talked about their crackdown on non-compliance, but there was also some interesting information about how accountants can actually interface with Companies House, specifically regarding registration as an ACSP. And for those who might not be familiar with the acronym, what exactly does that stand for?
Sure. So ACSP stands for Anti-Money Laundering Supervision. And it essentially boils down to having the credentials to carry out certain tasks related to company formation and registration. It's all about maintaining transparency, preventing financial crime.
Right, because if you're setting up a company or acting on behalf of a company, you need to be able to demonstrate that you understand the rules and regulations, especially around money laundering. So what's new with ACSP registration?
Well, as part of the government's push towards digitization, the entire process has been moved online. So no more paper forms, no more lengthy postal applications, a definite win for efficiency.
Always good to hear. But beyond that streamlined process, what's the key takeaway for accountants when it comes to interacting with Companies House in this new landscape?
I think the key takeaway is that Companies House is no longer just this passive registrar of information. They're taking a much more proactive role in ensuring that the information they hold is accurate, up to date, and above board.
Transparency and accountability are the name of the game.
Absolutely. And these changes are just one piece of a much larger puzzle as the government grapples with, issues of economic crime, corporate transparency, and of course the perennial hot potato of taxation.
And speaking of taxation, let's turn our attention to another area that's been generating a lot of buzz: potential increases to income tax and national insurance contributions. These are two areas that directly impact people's take-home pay, so any talk of increases is always going to be met with a mixed response. It does feel like we're talking about a bit of a balancing act for the government, doesn't it? Trying to address this budget deficit without putting too much pressure on everyday people. What's the current thinking on these potential increases to income tax and national insurance, and who might feel the pinch the most?
You've hit the nail on the head with that balancing act analogy. It really is a tightrope walk for sure. On the one hand, the government needs to find ways to, increase revenue. We're talking healthcare costs, pensions, essential public services.
Yep.
Those don't fund themselves right.
Right, and it feels like those costs are always on the rise.
They are. But on the other hand, you don't want to stifle economic growth by taking too much out of people's pockets. So it's a bit of a catch-22.
It is, yeah.
And that's why income tax and national insurance are such, contentious issues. They directly impact people's take-home pay. So anytime there's talk of increases, it's going to be a sensitive topic. You're always going to have, strong opinions on both sides of the debate.
So what are the arguments for and against raising these particular taxes? Are there any alternative solutions being proposed, or is it simply a case of we need more money, so someone's got to pay up?
Well, those who support raising income tax and national insurance would argue that it's a necessary evil, so to speak.
Right.
They point to the rising costs of, as we said, essential services, especially healthcare and pensions. And they argue that a modest increase for everyone is the fairest way to ensure those services are adequately funded.
Essentially spreading the cost across a wider base, even if it means individuals feeling a bit of a pinch.
Precisely. But of course, there's the other side of the coin as well. Opponents argue that, raising taxes on income is counterproductive. They say it discourages work, stifles investment, and ultimately hinders economic growth. So they would rather see the government, tighten its belt, cut spending, find efficiencies within the existing system rather than reaching into people's pockets for more.
It's fascinating, isn't it? Because you've got these two fundamentally different approaches to the same problem. And in reality, the solution probably lies somewhere in the middle. It's about finding that sweet spot, that delicate balance between responsible governance and fostering a healthy economy.
Absolutely. And I think it's also a good reminder that these aren't just abstract economic concepts we're talking about. These decisions have a real-world impact on people's lives.
Right. So for our listener who's been kind of diligently following along with this deep dive into UK tax and inheritance, what are the key takeaways? It feels like we've covered a lot of ground here. What should they be taking away from all of this?
If there's one message to take away from all of this, it's be informed, be proactive, and don't be afraid to seek expert advice. We've talked about potential changes to inheritance tax, capital gains, reliefs for farmers and business owners, even how Companies House is cracking down on noncompliance. It's a lot to digest.
It really is. And it can feel overwhelming, especially when you're trying to figure out how these potential changes might impact, your personal situation, your finances, your family.
Exactly. And that's where seeking professional guidance can be so invaluable. Talking to a financial advisor, a tax specialist, someone who understands the ins and outs of these very complex laws can make all the difference. They can help you to navigate those potential pitfalls, identify opportunities for tax optimization, and ultimately just give you peace of mind.
Knowledge is power, and in the often complex world of tax and inheritance, that's never been truer. By understanding the rules of the game, you're better equipped to play strategically and protect your interests and those of your loved ones.
Couldn't have said it better myself. It's about taking control of your financial future rather than just reacting to whatever changes come down the pipeline. And it's about, engaging in these important conversations.
Yeah.
Talk to your family, talk to your financial advisor, and just stay informed about the issues that matter most to you.
Beautifully said. And on that note, we'll leave you with one final thought to ponder. We've discussed how the UK government is potentially gearing up for some significant tax changes and how those changes might impact individuals, families, and businesses across the country. But it's important to remember that tax policy is about more than just numbers on a balance sheet. It's about shaping the kind of society we want to live in, funding the services that matter most, and ensuring that everyone has the opportunity to thrive. So as we move forward, the question becomes, what role do we want tax policy to play in shaping our collective future?
It's a question worth asking, and one that requires careful consideration and open dialogue. It's about finding that balance, between individual responsibility and collective well-being, between economic prosperity and social equity.
It's about making informed choices that benefit both ourselves and the generations to come. And on that note of thoughtful contemplation, we'll wrap up this deep dive into UK tax and inheritance. Until next time, thanks for listening.